Are you overcomplicating your investment portfolio? Building a robust investment portfolio isn't just about what you include, it's also about what you leave out. But here's where it gets controversial. Some popular investment categories might be doing more harm than good. Let's dive into 5 investments you might not actually need and explore why simplicity can often be your best strategy. The essentials, what every portfolio needs. Before we unpack what to avoid, let's clarify the must-haves. Christine Benz, Morningstar's Director of Personal Finance and Retirement Planning, emphasizes 3 core components. 1. Equity exposure. Broad market equities, both U.S. and international, form the backbone of a portfolio. While international exposure might spark debate, it's a key ingredient for diversification. 2. Fixed income exposure. Bonds become increasingly vital as you approach retirement, acting as a stabilizer against equity volatility. 3. Cash investments. Essential for emergencies or retirement withdrawals, cash provides a safety net during market downturns like 2022, when both stocks and bonds plummeted. 1. Real estate equities, the diversification myth. And this is the part most people miss. Real estate equities have increasingly moved in lockstep with the broader U.S. equity market over the past 2 decades. Christine Benz points out that their correlation has risen steadily, eroding their diversification benefits. While they might offer attractive dividend yields or occasional value opportunities, they're not the portfolio stabilizer they once were. Plus, if you own a home, you already have real estate exposure. Do you really need more? 2. Sector funds. Timing is everything, and rarely in your favor. Sector funds often lure investors after a stellar performance run, but here's the catch. By the time you invest, the momentum may already be fading. Benz highlights that low correlations between sectors and the broader market are often short-lived. For instance, energy sector correlations have recently been low, but history shows these patterns can reverse quickly. Are you willing to bet on timing? 3. Thematic funds, duplicating exposure without realizing it. Thematic funds, like those focused on AI, often launch after a trend has already peaked. But here's the twist. Many themes are already well represented in broad market indexes. For example, AI exposure is abundant in a standard U.S. equity index. By investing in thematic funds, you might be doubling down on positions you already hold, increasing concentration risk rather than diversification. 4. Long-term bonds, volatility in disguise. Long-term bonds are often touted as equity diversifiers, but their performance can be surprisingly volatile. During the 2022 market downturn, long-term bonds failed to provide the expected cushion. Benz notes that their standard deviation, a measure of volatility, is significantly higher than that of core bond indexes. If you're seeking stability, a core fixed income portfolio might serve you better. 5. High-yield bonds, income at a cost. High-yield bonds, or junk bonds, are popular for their income potential. But here's the controversial part. They often move in tandem with equities, offering little diversification. When stocks fall, high-yield bonds frequently follow suit. Benz argues that a high-quality fixed income portfolio provides better diversification without the added risk. Do you really need the extra income if it comes with higher correlation? Final thoughts. Simplicity is powerful. Avoiding these 5 investments doesn't mean missing out. It means focusing on what truly matters. But what do you think? Are real estate equities or high-yield bonds worth the risk for your portfolio? Or is simplicity the ultimate sophistication? Share your thoughts in the comments. Let's spark a conversation.